Remember the typical financial relationship between risk and return. When you take more risk, you tend to make more money over time. You take less risk, you tend to make less money over time. Well, the thing is what if there was a way you can reduce that huge outlier exposure that could happen in a financial catastrophe, but still elevate your risk on the days where the market doesn't really do much? Because after all, if you're willing to risk 1, 2 to 3% a day, most times the stock market doesn't move near that 95% of the time. We use those tools day investing in order to make the risk profile of the portfolio as close as possible to what the client actually wants. And the way we do that is by taking away some of that outlier exposure that could happen in a financial catastrophe, and instead we amplify the risk that we tend to see on a daily basis. That way, if you're willing to risk a little bit more on a day-to-day basis, you can make a little bit more on a day-to-day basis. And remember, if 90% of the time you just take a little bit more risk, then those additional returns should compound themselves into a much more sizable investment account over the span of 10, 20, or 30 years. In the meanwhile, you save yourself from that nasty drawdown situation that could occur in a financial crisis.